Hey everybody, it's Trader Razor from Conquer Wall Street. Today is November the 28th, and I'm excited to share with you my long term technical analysis of the major stock market indexes, stock sectors, Bitcoin, and a few of our trading systems that I've built for busy investors that work during normal trading hours but want to profit from an easy to follow end of day trading strategy. Now, I know a lot of people watching might be seasoned investors while others are just starting out. It's perfectly okay. If you have any questions at all, don't hesitate to reach out to our support team at conquerwallstreet.com. We're here to help you navigate this wild world of investing. Remember, this analysis is just one more tool in your toolkit to help you gain insights into the markets. And speaking of the markets, it has been a wild week. The Dow Jones Industrial Average, the S&P 500, and the Nasdaq have all had big down days just today alone. And a lot of that was news driven. The big news of the day was the PCI index, which showed a 0.4% increase for the month. That would have been the biggest monthly gain since January of 2024. And that would put the 12-month inflation rate at 2.8%. And that's not good. And that's part of the reason why we're seeing gold performing so well lately. Uh, that is something we need to keep an eye on. We never like to see gold being a leader in the stock market, and it is. It's a very defensive uh, sector for the market to have leading right now. The other big news was consumer confidence plummets to the lowest level since January of 2021. I believe the consumer confidence slid 7.2% or 7.2 points this month to a reading of 92.9. Also, not good news. We need to have a strong consumer for the markets to push higher. Consumer weakness is bad because the consumer is what drives the markets. Strong consumer spends money. When people spend money, businesses make profits, and profits are good for stock prices. And the big concern I have for the market is something I've been pounding the table on for weeks. If you've been following me, is the valuation of the S&P 500. The current value or the current PE ratio of the S&P 500 is sitting at 36.8, and this is 80% above its modern day market average of 20.4. And why this is a big concern is because the markets are priced for perfection. So if the bullish argument doesn't pan out for the markets the way we thought it was going to pan out, we could see a significant correction down to the downside uh, to probably, at a minimum, a price to earnings multiple of around 20 again to hit that 20-year average. So we really need some bullish news, and it doesn't look like we're going to get it with tariffs, with inflation being persistent and sticky. The future looks murky, and we all should be paying attention to the warning signs that the stock market is giving us. But on a positive note, uh, the initial claims for unemployment have been remaining steady. And this is something I really want to keep an eye on because with Doge and the layoffs that are happening in the federal government, we could see a spike in initial claims if those workers that have been working for the federal government that are getting laid off aren't finding new jobs in the private sector. When unemployment claims start to rise, it is usually a leading indicator of a significant stock market correction. And also on the positive side is the stock market loves low interest rate. And when we look at the FedWatch tool and we look forward to the month of May, a little bit more than 30 days out, the market is pricing in an 82% probability of a rate cut in May. A lot of times, if we do get that rate cut, we see a positive move in the stock markets as interest rates are beneficial to higher stock prices. So we need to keep an eye on that. We need to see if those odds start to change as we get closer and closer to the month of May. But right now, it is almost a sure thing, according to the FedWatch tool, that we will get a rate cut in the month of May. The other thing I want to point out to you is everybody's scared in this market, but if you were one of our free members following our Trendmaster Pro systems, which you can get absolutely for nothing on our website, conquerwallstreet.com, you would have seen that we've sold out of our long-term holding in the Nasdaq QQQ ETF just a few days ago, about 5 days ago, 5 trading days ago. You see this little flag over that says cash. And this system has treated us quite well. It's a long-term holding system. It holds its positions from months to years. And over the last 10 years, it's made a 100% profitable trades, 16 total trades. And here you can see some of those stats. I will not bore you with that. You're welcome to pause the video and look this over a little bit more closely. But we offer these absolutely free on our website for the S&P 500 SPY ETF, the Dow Jones Industrial Average ETF, DIA, and the NASDAQ ETF, QQQ. And you can get those alerts in your email 100% free anytime. So let's move forward to our equity market analysis for the week ending March 28th. I'm sorry about the typo on the screen. It is not January 3rd. It is March 28th. And the first chart I want to show you is the monthly chart of the SPY ETF. And the reason I want to show you the monthly chart is because in a healthy market, we get these recurring pullbacks to the 50-month moving average. As the market trends upward, we get a pullback and touches the 50-month moving average. We get a correction, pulls back to the 50-month moving average, and it bounces off of that 50-month moving average. Well, look how far extended we are currently from the 50-month moving average. Right now, it's sitting at about $459 a share. And the price of the SPY ETF closed today at about $555 a share. So there's almost 100 points worth of downside to come down in a correction to touch that 50-month moving average and still be in a long-term uptrend. And you see this breaks out with a little bit of a cup and handle pattern that we had at that price point. So let's keep an eye on that. That could be a possible target if we continue to get bad news in the markets. If tariffs and the tariff wars continue to heat up, that's one price point that I'm watching for the future. And we see the same thing in the QQQs. We are well extended from that 50-month moving average, but there is also another trend line down here I drew on the chart. If that 50-month moving average on the Qs would be given up, you could conceivably see this come back and touch this trend line and still be in a long-term uptrend on the Qs. But that would be priced currently somewhere below $300 per share, and that would be a much more significant correction on the Qs than on the SPY. Dow Jones Industrial Average is a lot more conservative as it's a blue chip index, but we see that extension from the 50-month moving average at about currently $363 per share. Here's a weekly chart of the SPY. Get a little bit of a zoomed in view. And what you want to see on this chart is that on the 50-week moving average, we're currently battling to try and regain that 50-week moving average in the SPY. If it doesn't hold in this area and regain support above the 50-week moving average, we see that the volume is really thin on the volume profile. And it doesn't really pick up until we got to this cup and handle I talked about earlier, where we had a breakout. And that aligns with the 200-week moving average. So there is that target again, right around that 459 price point, where if we continue to have problems in the market, whether that's through tariffs or other bad news that we receive, that we could see a target to the downside of about $459 per share. The QQQ, same thing. Volume profile, we really see things pick up coming out of this cup and handle that we had and a breakout right in that price point of about $386 per share. And the Qs, like the SPY, is below its 50-week moving average. Dow Jones Industrial Average, same story, cup and handle. And this index, though, is currently right at about its 50-week moving average. Can't quite tell looking at the chart if it's above or below, but it is right there in the vicinity. Here's a picture of the daily chart of the SPY, and we just have a long-term look. We had a big divergence going back from July all the way through March, where the RSI continued to hit lower highs while the S&P 500 was hitting higher highs, and that divergence played out. We had a big sharp decline right coming out of the month of March, and we're looking to find a bottom somewhere in the SPY. Here we have a daily chart of the SPY also. Ignore the Trend Master Pro on here. I don't have that indicator on the chart. We do have the 50-day and the 200-day moving average. And you see we are trading below that. The 200-day acted as resistance on the bounce. It looks like we got a bounce near this order block we have in this range around $5.50 per share. Now we're looking to put in a a higher low. So we need to see this 554 price point hold. If that doesn't hold, we really need to see this order block hold in this 550, 540 price range. But this chart does not look good, folks. Here's Nasdaq QQQ, same story, but we see that we're testing the support that we just had a week ago in the Qs. And the order block for the Nasdaq QQQ ETF is much lower here, currently about 440. So about 20 points to the downside to hit this order block. Hopefully we get a bounce off of that. If not, we have other order blocks below, but we are really not looking good in the QQQs. You have a slight higher high that we put in just before the end of the month of March, but now we have lower lows. So this chart remains bearish until you take out that high around 540. You need to see to change the bullish argument from a long-term perspective. We really need to take out that 540 level on a lot of these indexes. We need to take out the previous high to know that we have a better opportunity to be long for a longer period of time. Dow Jones Industrial, same thing, except we didn't get a higher high in the February, March. We got a little bit of got a lower high, barely, but we got a lower high. And now we're putting in lower lows. We did get a retest. I have this trend line drawn on here. We can't quite see this cut off in the chart, but it retested that lower low right near this order block. And now we're getting rejection again at the 200-day moving average and Dow Jones Industrial Average. We'll keep an eye on this, but this has been performing well. But again, it is more conservative because of its blue chip holdings. Okay, so here we have a chart. This is the percent of stocks trading below their 20, 50, and 200-day moving averages. And the reason I pull this up is we had a little bit of a divergence here. This is a great indicator when we're getting a correction or a pullback. If we start to see a divergence like we did right here in this upper indicator, this is the percent of stocks trading above their 20-day moving average. We start to see a divergence in this indicator, and that led to a move from about 580, it looks, on up into above $600 per share on the SPY. Now, we're not seeing that, but what we do see is it did trade below 30. We had that on the 50, the stocks trading below their 50-day moving average, and we had it on the 20-day moving average. And then we got a move back above there. And that just shows that the market was deeply oversold. You can usually get some type of a bounce off of that. And we did. We got a bounce about a week ago, a little bit more than a week ago, off of that deeply oversold market conditions. But here's the thing, the percent of stocks trading below their 200-day moving average never got below that 30 level. And that is something to watch out for. If we can get all three of these below 30, that's going to be incredibly bearish. But when all three of them trade below 30% and then move above, usually you see a significant upside move in the market and the restart of a bull market. We don't have that yet. We don't have that deeply oversold condition yet on the 2% of stocks trading below their 200-day moving average, but we're going to keep an eye on that. And for those of you that follow the max pain theory, currently the max pain for options expiring on April 17th is about $575 per share. And that gives the argument that we could be range bound at the current price level on the S&P 500 going into the next couple of weeks. And you'll see that on the chart here. This chart is not correct. I apologize for that. I should have deleted that. We'll skip over that. And we'll go on to the stock sector analysis for the week ending March 28th. And looking at this chart, you wouldn't think that things were so bad. You see technology didn't perform quite so bad over the last 5 days, only down 0.88%. And you see things like consumer discretionary that was up 3.36% over the last 5 days. And you think, well, those are kind of bullish sectors. That doesn't look too bad. But when you are a member and you look at our stock sector rankings, we took a little bit longer term perspective when we look at how sectors are performing. We analyze them on a weekly momentum rank and a monthly momentum rank. And then we combine those ranks and we compare it to the S&P 500 to see which sectors are outperforming and which sectors are underperforming. And here's the problem we're having, folks. Right now, this is a week old. I haven't updated this yet, but if you subscribe at conquerwallstreet.com, in the next few hours, this will be updated. The trouble we have, though, is the gold sector is outperforming. And you see on a weekly rank and a monthly rank, the defensive gold sector is the top performing sector in the markets right now. And we have financials, which are both beating the S&P 500, but we're starting to see a little bit of a weakness on the weekly rank of the financial sector, while the monthly rank is still high. So that shows that there's a little bit of money starting to rotate out of the financial sector. The other thing that's troubling to me is the other sectors that have made big moves. We have defensive sectors, utility, which is coming off of being a bottom sector and moving up these rankings quite quickly. Another sector, consumer staples, just a few weeks ago, this was a bottom feeder on these rankings. So utilities, consumer staples, gold sector, they're all competing for top spots. And what's even more troubling is the technology sector has been dropping like a rock. In a bull market, technology is always one of my outperforming sectors that are way above the S&P 500. And look at the difference in weekly momentum rank and monthly momentum rank. It's down to 66 versus 89. Money is rotating out of the technology sector quickly, and it's going into these defensive sectors. This is not a bullish argument for the markets. So please, 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 if you're not already a member and you care for nothing else, just follow these stock sector rankings so you know what's going on with the markets. You can know quickly just by looking at this chart, or I should say this data table. And to support my argument, here we have a ratio of the RSP ETF versus the S&P 500. RSP is the equal weighted version of the S&P 500. And if you understand how the weighting of the S&P 500, or the SPY ETF, I should say, is, it's heavily weighted to big tech companies like NVIDIA, Microsoft, Google, Meta, and they take up a large portion of the S&P 500. I think it's about 30%. So the RSP holds all the same assets as the S&P, as the SPY, but they're equally weighted. And what we're seeing is the RSP is outperforming the S&P 500. This is trending upward while the market is trending downward. And that's telling me that those big leaders, those magnificent seven stocks, money is coming out of them. I don't care what anybody's telling you on social media. This chart says it all. Money is coming out of those big tech names, and it's going into things that are priced a little bit more attractive and are a little bit more conservative. Here's another chart. MAGS ETF versus the SPY. That is the Magnificent 7 ETF. We see it's been correcting downward, has a big down candle today in the Magnificent 7 ETF. And what's going on? When we compare the MAGS ETF to the SPY, it is trending down. Even though the S&P 500 is weak or the SPY ETF is weak, the MAGS ETF is performing worse than the SPY ETF. Here we have growth versus value. Here's another thing. The market is showing signs of risk off. Growth stocks are underperforming value stocks. So this is trending down. So money is rotating out of growth stocks and it's rotating into value stocks, not a bullish setup. And where's it rotating to? It's rotating to gold. And here's what concerns me. Gold, typically, as we see here, it has these periods where it consolidates. And you see it on the volume profile. There's a big chunk of volume in here. And there's this consolidation in gold. Then it breaks out to the upside. And you get a move to the upside. And then it consolidates, like we see here on the volume profile again. In the months of October, November, December, we're consolidating. We're going sideways. And it breaks out to the upside. But then we have a little short consolidation period again here in March. 1 month of the whole month of March just kind of consolidated sideways. Now we're breaking out again to the upside. And I think the spot price of gold is right about $3,100 per ounce. So what's concerning to me is that gold not only is a conservative sector, but the periods of consolidation that's going through are starting to get shorter and shorter each time. And we're seeing breakout after breakout in the chart of the GLD ETF. And here's what doesn't support a bullish argument for the markets is the technology sector is not leading. Look at this. So we have the tech sector trading well below its 200-day moving average, well below its 50-day moving average. And we're looking at a bearish golden cross right here. The 50-day moving average is right up against the 200-day moving average, and it's about to cross. That is a huge bear signal for technology. And technology is starting to lead to the downside. Look at the distance between the technology sector and its 200-day moving average compared to a lot of sectors, and you're going to see that this is where massive amounts of money are moving out of the markets. Onto our Bitcoin analysis. Fear and greed index. We are currently sitting at a lot of fear, not extreme fear, which is concerning to me because Bitcoin really hasn't made a significant move to the downside. It's been holding up pretty well, considering everything that's going on in the stock market. And a lot of times when there's risk off in the stock market, you'll see that same risk off come into the cryptocurrency markets. We're not really seeing a massive fear move in Bitcoin. I don't know why. If we did get a massive fear move, we would probably see a sharp correction in Bitcoin, and that would provide a really good opportunity to buy more for you dollar cost averagers and you hodlers. But right now, we're not at that extreme fear level yet. It could be upcoming. We'll have to see what the news is coming moving forward in the stock market and cryptocurrency markets. As far as flows, though, one of my favorite things to watch is the digital asset fund flows report, so we can see where money is moving. And we can see a lot of money this week moved into Bitcoin, although a lot of money has moved out of Bitcoin for the week. And then I don't see a whole lot of money going into Ethereum. Ethereum has been weak lately, and the chart of Ethereum has been pretty ugly. I'm not quite sure what's going on with ETH, but Bitcoin is relatively stronger in the short term than Ethereum is. And here we have a chart of the long-term holder supply. One thing that is concerning to me is you see in the green shaded area in the back is the long-term holder supply. And you see these dips and you see the price of Bitcoin go up. And then you see the long-term holders are selling their positions into the strength of the market. And then you see a little bit of a correction coming out and they start buying that dip. Well, what we have in the near term here is since July of last year, we're seeing a long-term holder supply. They've been selling this move up into that $100,000 price point on Bitcoin. And now they're starting to come back in buying a little bit. So we're going to have to keep an eye on this. We didn't really get a sharp correction in Bitcoin. And I'm going to watch this chart to see if the long-term holders are starting to buy back in at this price point, or if this is just a little bit of a blip in this significant pullback, and we might see a sharper correction in the price of Bitcoin. And here we have the Bitcoin exchange reserve. This is a little bit of a lagging indicator, as this is about a month behind. But one of the reasons Bitcoin might be holding up so well is there's not a lot of supply on exchanges. And if you're going to see a big move to the downside, people have to put their money on the exchanges so they can sell it. And we're not seeing that. We're seeing money coming off of exchanges. Here is a chart of Bitcoin. Again, ignore the Trendmaster Pro that's on here. It is not a Trendmaster Pro chart, but we do have a system for that. This is the weekly chart of Bitcoin paired with US dollars. And we see we had a break of structure right here, just above 70,000. We had a breakout to the upside. On the weekly chart, we have a bullish alignment where the 50-week moving average is trading above the 200-week moving average. And it is currently holding the 50-week moving average. We got a little bit of a bounce off of that. As long as we're above this 50-week moving average, I feel pretty good about Bitcoin. We could come down here and test this level just about 75,000 on the weekly chart where we had the break of structure, and that would be okay. And we also have a little bit of a trend line coming up through here and an order block sitting around 60,000. But this wouldn't change the long-term picture on this weekly chart for me. You still have a bullish uptrend, even if we get a more significant pullback into this $60,000 to $70,000 price point. Here's another view of the weekly chart. We see that we had a cup and handle on Bitcoin on the weekly chart, and then we got that breakout. Typically, a cup and handle pattern is a long-term bullish signal. So that would argue that we're getting a little bit of a blip in the road and that Bitcoin will recover from this pullback and continue to take off because it's a weekly chart. It's a little bit longer term outlook when you see a cup and handle breakout on a weekly chart. The other thing I want to tell people is that typically when we get an oversold condition on the RSI on the weekly chart of Bitcoin, as you see down here in July of 2022, and it comes above there, we typically get a buy signal and we get a big move. And we got that here. It was trading around 20,000, 25,000, and look where it went after that. So I'm going to keep an eye on if we ever get below 30 on the weekly chart. That could provide a good buying opportunity to the upside. Here we have the daily chart of Bitcoin US dollar, and we see the sloping 50-day moving average is getting close to a golden cross of the 200-day moving average. We're not quite there yet. And Bitcoin has been struggling and just bouncing up and down around that 200-day moving average and holding on to it so far. But you'll see the volume profile thins out if we get below that $80,000 price point, which could lead to that downside that we saw on the weekly chart, where potential down into that $60,000 price range where we have an order block and the volume starts to pick up. That's all I have for you today. Thank you for watching. As always, stay sharp and prosper.